Welcome to Audiobooks Vault. In this video, we will summarize the book The Intelligent Investor by Benjamin Graham. Let's start. Introduction. The Intelligent Investor by Benjamin Graham is not just a book about investing, it's a timeless guide to mastering the art of intelligent decision-making in the world of finance. Whether you're a seasoned investor or someone just starting out, this book offers a unique perspective that goes far beyond market trends and stock tips. Instead of chasing quick profits, Graham introduces a philosophy rooted in patience, discipline, and long-term value. Through his groundbreaking principles of value investing, he emphasizes the importance of understanding the true worth of a company, its financial health, and its potential for growth. What makes this book so compelling is its focus on practical strategies for managing risk and finding opportunities that others might overlook. Graham doesn't promise shortcuts to wealth, but rather equips you with the tools to make smart, calculated decisions that can weather economic storms and lead to steady growth. His advice is both accessible and profound, offering timeless wisdom that has shaped the careers of legendary investors, including Warren Buffett. In a world dominated by speculation and hype, the intelligent investor stands as a beacon of rational thought. It's not about gambling with your money, it's about investing wisely, with a clear mind and a solid strategy. If you want to understand how to protect your assets, avoid costly mistakes, and make decisions that stand the test of time, this book is your essential companion. Part 1: General Approaches to Investment. Part 1 of The Intelligent Investor lays the foundation for understanding the principles of sound investing. Benjamin Graham distinguishes between investment and speculation, emphasizing the importance of a disciplined approach grounded in thorough analyses. He advocates for strategies that prioritize the preservation of capital and reasonable returns, rather than chasing short-term gains. This section introduces key concepts like the impact of inflation on investments, historical market trends, and the psychological aspects of market fluctuations. Graham also categorizes investors into two types: the defensive investor, who seeks safety and simplicity, and the enterprising investor, who is willing to put in extra effort for potentially higher rewards. By focusing on realistic expectations and long-term strategies, this part equips readers with a framework to navigate the markets confidently, regardless of their level of experience. It serves as the cornerstone for intelligent investing, promoting patience, discipline, and informed decision-making. Investment versus speculation: results to be expected by the intelligent investor. Benjamin Graham begins his seminal work by differentiating between investment and speculation. Investment, as defined by Graham, is the practice of thoroughly analyzing securities to ensure the preservation of principal and the likelihood of a reasonable return. Speculation, on the other hand, is taking on significant risk in pursuit of uncertain profits. Graham emphasizes that while speculation isn't inherently wrong, it becomes dangerous when individuals fail to recognize it as such, blurring the line between investing and gambling. For investors, a clear objective is essential: preserve capital while earning satisfactory returns. Graham also discusses the need for realistic expectations. Historical market data shows that stocks often provide a higher return over time compared to bonds, but this comes with volatility. He advises investors to avoid being overly influenced by the market's highs and lows, as emotional decision-making can lead to significant losses. The chapter concludes by urging investors to define their approach and stay disciplined. Those seeking to speculate should allocate only a small portion of their portfolio to it and maintain a distinct boundary between speculative and investment activities. The investor and inflation. In this chapter, Graham addresses the impact of inflation on investments. Inflation erodes purchasing power over time, posing a risk to investors who rely on fixed-income securities or fail to factor inflation into their strategy. While bonds and cash may seem safe, their real value diminishes as inflation rises. Graham stresses that investors must incorporate inflation-proof assets into their portfolios. One of his key suggestions is to maintain exposure to equities, which have historically outpaced inflation over the long term. Stocks represent ownership in businesses, and as prices rise, companies often pass these costs to consumers, preserving their earnings. However, Graham cautions against assuming that all stocks will act as a hedge against inflation. Investors must still focus on quality and valuation. Graham also discusses other potential inflation-resistant assets, such as real estate and commodities, though these carry their own risks and complexities. His overarching message is to diversify and remain vigilant. By balancing equities with other asset classes, investors can mitigate the effects of inflation while protecting their purchasing power. A century of stock market history, the level of stock prices in early 1972. Here, Graham delves into the historical performance of the stock market, using data to illustrate patterns, risks, and opportunities. By examining a century of market trends, he highlights the importance of understanding context when evaluating stock prices. He stresses that the market is cyclical, with alternating periods of bull and bear markets driven by optimism, fear, and external economic factors. Graham discusses the valuation of stocks in early 1972, noting that they were neither excessively overvalued nor undervalued, offering a reasonable entry point for prudent investors. However, he warns against assuming that past trends will continue indefinitely. For instance, periods of high returns often lead to excessive speculation and eventual market corrections. One of the key takeaways from this chapter is Graham's advocacy for a contrarian approach. He advises investors to adopt a skeptical view of market euphoria and to look for opportunities when others are overly pessimistic. By maintaining a long-term perspective and focusing on intrinsic value, investors can avoid being swayed by temporary market conditions. Graham concludes by reinforcing the idea that while historical data provides valuable insights, it cannot predict the future. Investors must remain adaptable, relying on sound principles rather than attempting to time the market. General portfolio policy, the defensive investor. In this chapter, Graham introduces the concept of the defensive investor, a person who prioritizes safety, simplicity, and a steady return over aggressive gains. The defensive investor is someone with limited time or inclination to actively manage their portfolio, but still seeks to achieve financial security. Graham proposes a balanced portfolio consisting of stocks and bonds, typically in a 50-50 split. This allocation provides stability while allowing for growth. He suggests adjusting this ratio depending on market conditions, for instance, increasing bond holdings during periods of high stock valuations and vice versa. When selecting stocks, the defensive investor should focus on high-quality companies with a proven track record of earnings stability, dividends, and financial strength. Graham emphasizes diversification, recommending that no single stock represents a significant portion of the portfolio. This approach reduces risk by spreading exposure across industries and sectors. Graham also advises defensive investors to steer clear of speculative ventures, including hot stocks and market fads. Instead, they should stick to well-researched investments that align with their risk tolerance and goals. He highlights the importance of maintaining a disciplined approach, avoiding the temptation to chase higher returns at the expense of safety. The chapter concludes with Graham reiterating the need for patience and consistency. The defensive investor's greatest asset is their ability to remain steady during market fluctuations, focusing on long-term objectives rather than short-term noise. The defensive investor and common stocks. This chapter addresses how the defensive investor should approach common stocks. Benjamin Graham emphasizes that defensive investors prioritize safety and stability, so their stock selection must reflect these goals. He recommends focusing on companies with strong financial health, a history of consistent earnings, and a reliable dividend payout record. To reduce risk, Graham advises defensive investors to diversify. Hold shares in a minimum of 10 to 30 companies to mitigate the impact of any single stock's poor performance. Prioritize quality. Look for large, well-established companies with a solid track record. Maintain simplicity. Avoid speculative stocks, untested industries, and complex investments that are hard to understand. Graham also discusses the importance of valuation. Even high-quality stocks can become risky if purchased at excessive prices. Defensive investors should look for stocks trading at reasonable price-to-earnings (P/E) ratios and offering dividends that reflect good value relative to their price. He concludes by reinforcing the idea that the defensive investor should adopt a passive, hands-off approach, relying on systematic investment strategies rather than trying to time the market or chase higher returns. Patience and consistency are the hallmarks of success for the defensive investor. Portfolio policy for the enterprising investor, the positive side. In contrast to the defensive investor, the enterprising investor is willing to devote more time, effort, and skill to seek higher returns. Graham lays out the principles and strategies for this more active approach, emphasizing that while it carries higher potential rewards, it also involves greater risk. Key strategies for the enterprising investor include: undervalued stocks. Look for stocks trading below their intrinsic value. This requires a keen understanding of financial statements and the ability to identify mispriced securities. Special situations. Explore opportunities in distressed companies, mergers, or spin-offs where there is potential for recovery or growth. These situations often require deep research and careful judgment. Growth stocks. Consider companies with above-average growth potential, but only if they are reasonably priced. Graham warns against overpaying for growth, as this often leads to disappointing results. Bonds and other fixed-income securities. For diversification, enterprising investors can include high-yield bonds or other income-generating securities, though these should be selected with caution. Graham emphasizes that enterprising investors must be disciplined and selective. They should avoid speculative trades, resist market hype, and only pursue opportunities where they have a clear advantage. This chapter highlights the importance of skill, research, and emotional resilience in executing a successful enterprising investment strategy. The enterprising investor and market fluctuations. This chapter delves into the enterprising investor's relationship with market fluctuations. Graham encourages investors to see market volatility not as a threat but as an opportunity. He introduces the famous analogy of Mr. Market, a metaphorical figure who offers to buy or sell stocks every day based on his emotional whims. Mr. Market's offers often reflect irrational exuberance or fear, providing enterprising investors with chances to buy undervalued assets or sell overvalued ones. Graham advises enterprising investors to adopt a contrarian mindset. Buy during pessimism. When prices fall due to market overreaction, there may be opportunities to acquire quality stocks at a discount. Sell during optimism. When prices rise excessively, selling can lock in profits and reduce risk. He cautions against excessive trading and speculative bets, emphasizing that investors must remain grounded in fundamental analysis and intrinsic value. Market fluctuations are inevitable, but the enterprising investor can use them to their advantage by staying patient, rational, and disciplined. Graham also highlights the importance of maintaining a margin of safety during volatile periods. By purchasing assets at prices well below their intrinsic value, investors create a buffer that protects them from unexpected downturns. This concept is particularly relevant in times of market turbulence when emotions run high and decision-making can be clouded by fear or greed. The investor and market fluctuations. This chapter expands on the themes of market volatility, focusing on how all investors, defensive and enterprising alike, should navigate fluctuations. Graham underscores the importance of psychological resilience and the ability to remain unemotional in the face of rising or falling markets. He stresses that market fluctuations are natural and unavoidable. Instead of fearing them, investors should prepare for them by building a strategy that aligns with their goals and temperament. Defensive investors, for instance, should maintain a balanced portfolio and avoid reacting to short-term market swings. Enterprising investors, on the other hand, should view volatility as an opportunity to exploit mispriced securities. Graham also cautions against two common mistakes: overreacting to market declines. Selling in panic during a downturn locks in losses and often leads to missed recovery opportunities. Chasing speculative gains. Buying into overvalued assets during a bull market exposes investors to significant risk when the market corrects. The concept of dollar-cost averaging is introduced as a practical tool for managing fluctuations. By investing a fixed amount of money at regular intervals, investors can reduce the impact of market timing and emotional decision-making. This strategy ensures that more shares are purchased when prices are low and fewer shares when prices are high. Graham concludes by emphasizing the value of a long-term perspective. Market fluctuations are temporary, but the underlying value of high-quality investments tends to grow over time. By focusing on intrinsic value and avoiding the distractions of short-term market noise, investors can achieve their objectives with confidence. Investing in investment funds. In this chapter, Benjamin Graham examines the role of investment funds, such as mutual funds, in a portfolio. For many investors, these funds provide a practical and diversified way to participate in the stock market without requiring extensive time or expertise. However, Graham cautions that not all funds are created equal, and careful evaluation is necessary. Key considerations for selecting investment funds include: performance record. Review the fund's long-term performance, emphasizing consistency rather than short-term results. Graham warns against chasing funds with spectacular recent returns, as they often involve higher risk and may not sustain their performance. Management costs. Evaluate the fees and expenses associated with the fund. High fees can erode returns over time, so low-cost funds are typically preferable for most investors. Investment policy. Understand the fund's investment strategy and whether it aligns with your goals. Some funds may focus on growth stocks, while others prioritize income or value investing. Graham also discusses the potential pitfalls of investment funds. Many funds engage in speculative practices, chasing trends or attempting to outperform the market through aggressive trading. This approach often leads to increased volatility and diminished returns for investors. He advises sticking to funds with conservative and well-defined investment policies. For the defensive investor, Graham suggests considering index funds, which passively track a broad market index. These funds offer low fees, automatic diversification, and consistent returns that typically align with the overall market. The chapter concludes by emphasizing the importance of due diligence. While investment funds can simplify portfolio management, investors must carefully select funds that align with their risk tolerance, goals, and time horizon. The investor and his advisors. This chapter focuses on the relationship between investors and financial advisors. Graham acknowledges that many individuals lack the time, expertise, or confidence to manage their investments independently. In such cases, advisors can play a valuable role in guiding investment decisions. However, finding a competent and trustworthy advisor is crucial. Graham outlines the qualities of a good financial advisor. Competence. The advisor should have a solid understanding of investment principles, including risk management, diversification, and long-term planning. They should also be knowledgeable about securities and market behavior. Integrity. Trustworthiness is paramount. Advisors must prioritize their clients' interests over their own and avoid conflicts of interest, such as pushing high-fee products or speculative investments for personal gain. Practical advice. A good advisor focuses on realistic and achievable goals rather than promising spectacular returns. Their guidance should emphasize capital preservation, reasonable growth, and adherence to sound investment principles. Graham highlights common pitfalls when working with advisors. Many advisors, particularly those compensated through commissions, may recommend frequent trading or speculative investments to generate fees. Such practices can harm clients by increasing costs and exposing them to unnecessary risks. He advises investors to remain actively involved in their financial decisions, even when working with an advisor. This means understanding their own investment goals, asking questions, and staying informed about the recommendations being made. Graham also encourages investors to avoid over-relying on advisors for market predictions, as no one can consistently forecast short-term trends. For those unable to find a reliable advisor, Graham suggests exploring alternative options, such as simple and low-cost index funds or automated investment solutions, which minimize the need for professional intervention. The chapter concludes by emphasizing the importance of a collaborative relationship between the investor and advisor. Investors must take responsibility for their financial future, using advisors as partners in achieving their goals rather than delegating complete control. In conclusion, Part 1, General Approaches to Investment of the Intelligent Investor, sets the foundation for a disciplined, long-term approach to investing. Benjamin Graham emphasizes the importance of understanding the difference between investment and speculation, encouraging investors to focus on intrinsic value and financial stability rather than short-term market trends. He advocates for a conservative strategy that prioritizes safety, aiming to protect capital while seeking reasonable returns. By stressing the significance of a margin of safety, Graham equips readers with a clear mindset for navigating the complexities of the financial markets, encouraging a cautious and rational approach to building wealth over time. Part 2: Security Analysis for the Lay Investor. Part 2 of The Intelligent Investor dives into the practical tools and techniques of analyzing securities, specifically tailored for non-professional investors. Benjamin Graham demystifies the process of evaluating stocks and bonds, providing a structured approach that anyone can follow with diligence and common sense. This section emphasizes the importance of understanding the fundamental factors that determine a company's value, such as earnings, dividends, financial stability, and growth prospects. Graham guides readers on how to identify undervalued securities and avoid overpaying for speculative investments. He also compares companies with similar profiles to highlight the nuances of stock selection. By simplifying complex financial concepts, Part 2 equips investors with the confidence to make informed decisions. It encourages a focus on facts rather than market noise, reinforcing the idea that successful investing is about thorough analysis, discipline, and margin of safety. This part is invaluable for those seeking to build a resilient and well-researched portfolio. Security Analysis for the Lay Investor, General Approach. In this chapter, Benjamin Graham introduces the concept of security analysis, making it accessible to the average investor. His goal is to empower lay investors to make informed decisions about their investments by focusing on key principles rather than advanced techniques. Graham emphasizes that security analysis is not about predicting short-term market movements or speculative profits. Instead, it is a systematic approach to evaluating a security's intrinsic value based on its financial fundamentals. For lay investors, this involves understanding the business. Before investing in a company, it is essential to grasp its industry, business model, and competitive position. Evaluating financial strength. Focus on balance sheets, income statements, and cash flow to assess a company's financial health. Key indicators include debt levels, profitability, and liquidity. Assessing management. While harder to quantify, an honest, competent, and shareholder-friendly management team is crucial to a company's success. Determining intrinsic value. Compare a company's stock price to its estimated intrinsic value to identify undervalued opportunities. Graham underscores that lay investors should prioritize simplicity, safety, and reliability in their analysis. Rather than seeking perfection, they should aim to avoid glaring risks and invest only when there is a sufficient margin of safety. Things to consider about per-share earnings. In this chapter, Graham explores the concept of per-share earnings, a critical metric for evaluating a company's profitability. However, he cautions against taking earnings figures at face value, as they can be influenced by accounting practices, market cycles, or management's decisions. Key insights about per-share earnings include the impact of accounting practices. Earnings figures can be manipulated through accounting methods such as depreciation schedules, inventory valuation, or revenue recognition. Investors must scrutinize financial statements to understand the underlying numbers. Earnings stability. Consistent and stable earnings over time are more valuable than erratic or highly cyclical profits. Stability reflects a company's ability to weather economic downturns and maintain long-term profitability. Earnings growth. While growth is appealing, Graham warns against overpaying for high-growth companies. Rapid growth is often unsustainable, and paying a premium can lead to disappointing returns if growth slows. Normalized earnings. Instead of focusing on a single year's profits, investors should consider average earnings over a period, for example, 5 to 10 years, to account for economic cycles and provide a more reliable picture of profitability. Graham advises investors to use earnings as one component of a broader analysis rather than relying solely on this metric. Understanding the quality and sustainability of earnings is essential for making sound investment decisions. A comparison of 4 listed companies. This chapter offers a practical application of Graham's principles through the analysis of for real-life companies. He demonstrates how investors can compare stocks based on fundamental criteria to identify strengths, weaknesses, and opportunities. Graham's analysis focuses on several key factors. Financial strength. Companies with strong balance sheets, low debt, and ample liquidity are more likely to weather economic challenges and sustain operations. Earnings stability. Firms with consistent earnings and a track record of profitability are generally safer investments than those with volatile or uncertain results. Dividend record. A reliable dividend payout history signals financial health and management's commitment to returning value to shareholders. Valuation metrics. Comparing price-to-earnings, P/E ratios, book values, and other valuation measures helps identify whether a stock is reasonably priced or overvalued. Through this case study, Graham highlights the importance of a methodical, comparative approach to stock selection. Investors should weigh each company's strengths and weaknesses relative to their own objectives and risk tolerance. The chapter reinforces the idea that even lay investors can perform meaningful analyses by focusing on fundamental metrics and avoiding speculative considerations. Stock selection for the defensive investor. This chapter outlines a systematic framework for stock selection tailored to the needs of the defensive investor, who prioritizes safety, simplicity, and stability over high returns. Graham provides specific criteria to help defensive investors build a resilient portfolio. Size of the company. Large, established firms are generally more stable and less risky than smaller, unproven companies. Strong financial position. Companies should have low debt levels and a solid financial foundation to withstand economic downturns. Earnings stability. A consistent track record of earnings over at least 10 years is a key indicator of reliability. Dividend record. Defensive investors should favor companies with a history of uninterrupted dividend payments. This provides income and signals financial health. Moderate price-to-earnings, P/E ratio. Graham advises avoiding stocks with excessively high P/E ratios, as they often reflect speculative valuations. Moderate price-to-book, P/B ratio. Paying too much relative to a company's book value increases risk. Graham suggests looking for stocks trading at reasonable multiples of their book value. Graham emphasizes diversification as another critical component of the defensive investor's strategy. Holding a mix of 10 to 30 carefully selected stocks reduces exposure to individual company risks while maintaining the potential for steady returns. By adhering to these criteria, defensive investors can build a portfolio that balances safety and moderate growth, avoiding the speculative risks associated with chasing higher returns. Stock selection for the enterprising investor. In this chapter, Benjamin Graham discusses the strategies that the enterprising investor, an investor willing to put in more time and effort to actively manage a portfolio, should use for selecting stocks. Unlike the defensive investor, who prioritizes safety and stability, the enterprising investor seeks higher returns by taking on more risk. Graham provides specific guidelines and criteria for selecting stocks that have potential for outperformance, while also considering the risks involved. Key considerations for the enterprising investor include financial strength. While defensive investors look for strong financial positions, the enterprising investor may tolerate some financial leverage if the company is otherwise solid and the potential rewards justify the risks. This allows the enterprising investor to pick stocks that might have higher upside potential, but they must be cautious about the amount of debt a company is carrying. Earnings growth. Graham advises enterprising investors to seek companies with consistent earnings growth over the long term. While high-growth stocks can be attractive, the enterprising investor should focus on businesses that have the capacity to grow steadily, rather than chasing companies that are experiencing fleeting or speculative growth. Price-to-earnings, P/E, and price-to-book, P/B ratios. In selecting stocks, the enterprising investor must focus on moderate P/E and P/B ratios to avoid overpaying for shares. A reasonable price-to-earnings ratio reflects a company's solid fundamentals and growth potential without overinflating expectations. Dividend policy. Although not always essential for the enterprising investor, a solid dividend policy can signal financial health. However, Graham also notes that reinvesting earnings for future growth can sometimes offer a better return than dividend payouts, particularly for companies in growth stages. Special situations. The enterprising investor may also look for special situations, companies that are undervalued due to temporary problems or changes that the market has not yet priced in. These opportunities include distressed companies, spin-offs, or mergers that present an opportunity for higher than average returns. Graham stresses that although the potential rewards are higher for the enterprising investor, so are the risks. It is crucial for the investor to have a deep understanding of the companies in which they invest, as well as a clear strategy for managing risk. Patience and discipline remain essential in the process. Convertible issues and warrants. This chapter dives into convertible issues, convertible bonds or preferred stocks, and warrants as unique investment instruments that present both opportunities and risks. A convertible bond allows the investor to convert the bond into a predetermined number of shares of the company's stock, while a warrant provides the right to purchase a company's stock at a specified price before a certain expiration date. Both instruments are designed to offer the potential for higher returns, but they come with unique characteristics that investors must understand. Key takeaways from the chapter. Convertible bonds. Convertible bonds can be appealing because they combine the security of a fixed-income investment with the upside potential of stock price appreciation. However, Graham points out that these bonds often trade at a premium due to their conversion feature, meaning that investors may pay more for the convertible bond than its inherent value. The upside comes into play if the company's stock price rises significantly. Warrants. Warrants are speculative instruments that provide an option to purchase stock at a predetermined price. While warrants allow investors to benefit from stock appreciation, they are often more volatile than regular stocks, and their value can evaporate if the stock price does not rise above the warrant's exercise price. Risks. Both convertible bonds and warrants carry specific risks. The conversion feature of a bond is only valuable if the stock price rises, so investors must evaluate the likelihood of that happening. Warrants, on the other hand, may become worthless if the company's stock doesn't reach the exercise price before the expiration date. Both instruments can introduce significant risk to an investor's portfolio, and they require careful analysis of the underlying company's fundamentals. Valuation. Graham stresses the importance of assessing the value of convertibles and warrants based on their fundamentals and market conditions. While these instruments can offer a good balance of risk and reward, they should not be purchased without a thorough understanding of the company's financial position, growth potential, and stock price outlook. Graham's advice here is clear. While convertible bonds and warrants may offer attractive returns, they are more speculative in nature and should be approached with caution. The enterprising investor should be especially careful when considering these instruments, ensuring that the potential rewards justify the risk. For extremely instructive case histories. In this chapter, Graham uses real-world examples to highlight for instructive case histories that showcase the application of his investment principles. These case studies demonstrate the importance of careful analysis, understanding market fluctuations, and having a disciplined approach to security analysis. The 4 case histories include: Case 1. A rapidly growing company. Graham discusses a company that experienced rapid growth but became overvalued by the market. Although its earnings and stock price grew significantly, the company's price was eventually unsustainable. Investors who chased growth and failed to recognize overvaluation ultimately suffered losses. Case 2. A distressed company. This company faced financial difficulties and a declining stock price. However, it had strong underlying assets that the market had overlooked. The company ultimately recovered, and investors who understood its fundamentals and bought in at a low price saw significant returns. Case 3. A consistently profitable company. This company demonstrated steady earnings growth and paid a regular dividend. Investors who bought shares in this company based on its solid performance and stability enjoyed reasonable, if unspectacular, returns. Case 4. A speculative company. This case involves a highly speculative company that lacked solid financial backing but experienced a brief surge in stock price. Despite the initial excitement, the company failed to deliver long-term value, highlighting the dangers of speculative investments. Graham uses these case histories to reinforce the importance of understanding a company's intrinsic value and avoiding the pitfalls of speculative investing. The key lesson is that investors must not be swayed by market trends or emotions. They should focus on fundamentals and buy when there is a significant margin of safety. A comparison of 8 pairs of companies. This chapter involves comparing 8 pairs of companies across various sectors to help investors evaluate their relative attractiveness based on fundamental metrics. Graham compares companies in terms of their earnings growth, financial stability, dividend policies, and overall valuation. The comparisons include established versus emerging companies. Some pairs consist of a well-established company and a newer, more speculative one. Graham advises that while the emerging company may offer higher growth potential, the established company offers greater stability. Investors must balance the trade-off between risk and return. Highly leveraged versus low-leverage companies. Some companies in the comparison are heavily leveraged, while others have minimal debt. Graham notes that companies with high debt levels are more vulnerable to market fluctuations and economic downturns, and thus present higher risk. High P/E versus low P/E companies. Graham also compares companies with high price-to-earnings ratios against those with low P/E ratios. High P/E companies may offer growth potential but at a premium price, while low P/E companies may be undervalued and offer a better margin of safety. Growth versus value stocks. The comparisons also touch on growth stocks, which often come with higher volatility, and value stocks, which tend to be more stable but offer lower growth prospects. The key takeaway from this chapter is that every investment decision involves trade-offs. The investor must evaluate each company's financial position, growth prospects, and market valuation to make an informed choice. Graham emphasizes that the margin of safety is crucial, and it's better to invest in companies with solid fundamentals that are undervalued than to chase growth without regard for price. In conclusion, Part 2. Security analysis for the lay investor equips everyday investors with the essential tools to evaluate securities without needing advanced technical knowledge. Graham emphasizes the importance of focusing on a company's fundamentals, such as earnings stability, financial strength, and valuation, rather than speculative trends. By simplifying the process of security analysis, he provides a clear framework for making informed, rational investment decisions. This part encourages lay investors to approach the market with caution, relying on thorough research and a focus on long-term value, rather than chasing short-term profits or trends. Part 3. Conclusions. Part 3 of The Intelligent Investor ties together the book's key principles, focusing on practical applications and enduring lessons. Benjamin Graham emphasizes the importance of a disciplined, long-term approach and the central concept of the margin of safety, the cornerstone of intelligent investing. This section reinforces the need for balancing risk and return while maintaining a rational and unemotional mindset in the face of market fluctuations. It serves as a timeless reminder that successful investing is rooted in patience, analysis, and sound judgment. Shareholders and management's dividend policy. In this chapter, Benjamin Graham examines the relationship between shareholders and corporate management, focusing on the crucial issue of dividend policy. Dividends represent a portion of a company's earnings paid out to shareholders and are a key consideration for investors evaluating stocks. Graham argues that dividends serve as a tangible reward for shareholders and reflect a company's financial health and management's respect for its owners. For conservative investors, regular dividends provide income and evidence of stability, making dividend-paying stocks an attractive choice. Key points discussed include dividend consistency. Companies that maintain consistent dividend payouts over time demonstrate financial resilience and a commitment to shareholder interests. Graham emphasizes the importance of reliable income, particularly for defensive investors. Retention versus payout. Companies often face the decision to retain earnings for reinvestment or distribute them as dividends. Graham notes that while retaining earnings can fuel growth, it must yield a return that benefits shareholders. If management cannot generate superior returns from retained earnings, dividends should be prioritized. Shareholder rights. Graham emphasizes that shareholders have a right to expect fair treatment from management. Decisions regarding dividends, executive compensation, or the use of retained earnings should align with shareholder interests, not merely benefit executives or insiders. Graham also critiques the tendency of some companies to hoard earnings without a clear plan for productive reinvestment. He warns investors to be wary of management teams that prioritize growth at the expense of shareholder returns or refuse to distribute profits when it is in shareholders' best interest. The chapter concludes by urging investors to evaluate dividend policies critically. Companies with clear, shareholder-friendly practices are often better long-term investments than those with inconsistent or overly aggressive reinvestment strategies. Margin of safety as the central concept of investment. This chapter introduces the cornerstone of Graham's investment philosophy, the margin of safety. The margin of safety refers to the difference between an investment's price and its intrinsic value, providing a buffer against errors in judgment or unexpected market events. Graham explains that the margin of safety is vital for minimizing risk and ensuring long-term success. By purchasing securities at a significant discount to their intrinsic value, investors can protect themselves from the impact of market volatility, economic downturns, or miscalculations in valuation. Key aspects of the margin of safety include intrinsic value. This is the true worth of an investment, based on its fundamentals such as earnings, assets, and growth prospects. Investors must rely on careful analysis to estimate intrinsic value accurately. Price versus value. A stock's market price often deviates from its intrinsic value due to investor sentiment, speculation, or external factors. The margin of safety arises when the market price is well below intrinsic value. Risk mitigation. By maintaining a margin of safety, investors reduce the likelihood of permanent loss. This principle applies not only to stocks but also to bonds and other securities. Graham emphasizes that the margin of safety is particularly important during periods of market uncertainty or exuberance. It serves as a protective cushion, allowing investors to withstand market corrections or adverse developments without suffering significant losses. He also highlights that the margin of safety is not a guarantee of success but a principle that increases the probability of favorable outcomes over time. This conservative approach aligns with Graham's overarching philosophy of prioritizing capital preservation over speculative gains. The chapter concludes with a reminder that the margin of safety is the most critical tool for intelligent investors. By consistently applying this principle, investors can achieve steady, long-term growth while minimizing exposure to unnecessary risks. If you enjoyed the summary, then like the video and subscribe to Audiobooks Vault. Tell us if there is any other book you want us to summarize. Goodbye.